So as background, let me start with the observation that all recent US presidents have used tariffs. Lest we forget, President Obama put a tariff on tires from China. That was a special safeguard action, and also on solar panels, an anti-dumping action. President Bush, just before him, put a tariff on steel imports. He, in fact, exempted Canada, Mexico, Jordan, and Israel, and about 100 developing countries, but not the EU, interestingly, who then took it to the WTO, won a complaint there, and targeted some US goods for retaliation, such as oranges from Florida, Jeb Bush's state. President Bush then withdrew the tariff in 19 months. So the planned retaliation was effective in that sense. So what's different now? Well, President Trump has applied tariffs on solar panels and washing machines, also a safeguard action, perhaps not too different than President Obama's tariffs on tires and on solar panels. President Trump also applied tariffs to steel and aluminum, perhaps not unlike the steel tariff of President Bush. But what is different is neither Canada, Mexico, or the EU were exempted from the steel and aluminum tariffs. They've all retaliated. So this is not just planned retaliation, but actual retaliation. And there's no sign that those US tariffs will be removed. In addition, President Trump has applied 25% tariffs on $34 billion in Chinese imports to the US, with another $16 billion planned, and who knows what might come after that. China itself has retaliated just in the last week with a tariff on various goods in the US. President Trump is also investigating a possible tariff on automobile imports. This is on national security grounds, and that would especially hit Canada and Europe, who plan to retaliate. So as compared with past administration, there is a difference in the magnitude of trade actions in the current administration, and also in the actual, not just planned retaliation. So in this context, we might well ask, what are the costs of a trade war? And in trying to answer this, or suggest an answer, I'll sort of compare Canada and China. So let me start with Canada. Canada, in my view, is the prime example of the countries who realize the gains from intra-industry trade. And that was, in fact, the motivation for the Canada-US Auto Pact of 1965. It was very much the motivation for the Canada-US Free Trade Agreement of 1989. This is one case where economists completely won the day among Canadians, and based on the gains from intra-industry trade, and those were quantified by Rick Harris in Canada, that totally paved the way for the Canada-US Free Trade Agreement, and then the North American Free Trade Agreement followed naturally 5 years after that. Now, in my view, there's several alternative sources of gains from trade suggested by the monopolistic competition models, and I mean alternative to conventional comparative advantage. That includes product variety gains, pro-competitive gains, and also the gains from creative destruction. Now, since I mentioned pro-competitive gains, many in the audience might be thinking of the recent paper by Arkalakis, Costineau, Donaldson, and Rodriguez-Clare, the elusive pro-competitive effects of trade. They, in fact, show the pro-competitive gains are negative in the presence of non-homothetic preferences. But with homothetic preferences, they find gains from trade that are identical to the formula in Arkalakis, Costineau, Rodriguez-Clare. And in fact, those gains are entirely due to creative destruction. There are no gains from product variety and no pro-competitive gains in that model. Now, why is that? I would argue it's an aggregation effect due to the assumption of a Pareto distribution with unbounded support. That is, there is no highest productivity firm. There can always be a firm with higher productivity. And an aggregation effect of this type is also mentioned in recent work by Mary Amiti and Oleg and Joseph in a revision of their paper. Once we abandon the assumption of unbounded Pareto, then all three sources of gains for trade can operate. I, for example, have worked out the case of a truncated Pareto, truncated on the right side, so there is some highest productivity firm. In that case, all three sources of gains from trade operate. My calculations for the United States show that creative destruction is about 1/4 of those gains, and product variety and pro-competitive gains account for the other 75%, roughly evenly split between the two of those, and that's from recent work with David Weinstein. But in fact, the upper bound to the total gains from trade is still the formula from ACR or ACDR. And in other words, once we abandon unbounded Pareto, we consider other distributions of firm productivity, these other sources of gains from trade can operate, but the gains due to creative destruction are reduced such that the total is no higher than that formula in ACR and ACDR. We can also ask whether any of these sources of gains from trade can be negative. I already mentioned one case, and that was ACDR in the case of non-homothetic preferences. But this can also happen with homothetic preferences. Recent work by Cheng Tai-Sheh, Ralph Osa, and co-authors look carefully at the Canada-US Free Trade Agreement. They find negative gains from product variety for Canada. That is, there was more exit of domestic firms in Canada than entry of new product varieties from the United States. And that can certainly occur with a non-Pareto distribution. But let's not forget that the total gains from Canada are still positive, and Dan Treffler, for example, has documented the very strong evidence of gains from creative destruction there. So with that digression, if you like, on the gains from trade, let's ask the question, if we accept that Canada has these very strong gains from intra-industry trade with the United States, does that make Canada particularly vulnerable to losses from US tariffs? Or more generally, what are the costs of a US uniform tariff? And I'll speculate that this might hurt Canada particularly. So to check that, I go to the model of Caliendo, Feenstra, Taylor, Romales, a quantitative model. And I thank Lorenzo in particular for doing the calculations that I'm going to show you. So let's first look at a US optimal tariff. This is a uniform tariff on all goods at 7.15%, all goods and all countries. And you see the United States here in dark green. It's the big gainer from its own optimal tariff. Canada, in fact, is in dark red. It's a big loser, sort of confirming my expectation. We also see Mexico as a big loser, Argentina, Bolivia, Chile, and South America. And China itself is a big loser from this US optimal tariff. So now let's turn to China. We might think that the gains from trade in China are more in accord with conventional comparative advantage, but of course, we definitely need to extend that theory to allow for the very strong roles of supply chains in China that many people in this room have studied and written about. Surprisingly, the Trump administration is actually targeting industrial goods imported from China for the US tariffs and not consumer goods. I say surprising because that might have particularly high cost to US firms. Perhaps the explanation is the Trump administration is trying to avoid the direct cost to US consumers that they might see in the price tag in stores and are willing instead to put it on firms, but it's still surprising. So here we might ask, do supply chains make countries particularly vulnerable to large tariffs? Let me show the effects on China's total exports here from the US optimal tariff I referred to earlier. And we see, in fact, that this leads to particularly large declines of Chinese exports in transportation equipment, electrical equipment and machinery, also textiles and apparel and food. That was from the optimal tariff of 7%. Here I also show the larger declines from a hypothetical US tariff of 20%. This is hypothetically across the board, not what we've seen. So now we might switch and ask, what are the costs of a US uniform optimal tariff? And I'd speculate that this might hurt all countries that rely on China's exports of intermediate inputs. I say exports here because I'm thinking of China's optimal tariff as also an export tariff, appealing here to learner symmetry. So what are the results of this? Well, we see China in this map in the dark green, the gainer from its own optimal tariff. Many countries are in red throughout Western Europe, North America. A few countries are in light green. They gain slightly, Mexico, Brazil, and Bolivia, and some of the African countries. Perhaps they're relying on the same raw material inputs that China relies on, and their prices are being depressed. Finally, let me ask, what are the costs of a global trade war? And in this final map, we see many countries in red losing, China in particular in dark red, a few countries in green gaining slightly, Venezuela and Colombia in South America, many of the STAN countries in Turkey, and also a number of countries in Africa. Perhaps these countries are gaining from depressed prices from raw material. If you calculate what's happened to world trade in here, you find that it collapses by 20%, by coincidence, much the same number as after the global financial crisis. So let me quickly conclude. I find that the tariffs used by the Trump administration are more widespread than other administrations, and also they have led to actual and not just planned retaliation. Theory allows for alternative sources of gains from trade other than comparative advantage, but I've raised the speculative question about whether this can make countries more vulnerable to trade wars. And I've also calculated the effects of a global trade war which assumed 5% uniform tariffs across the board. And I find that leads to the same fall in global trade as the Great Recession. Thank you.
Thank you very much, Rob.
These are very interesting times for trade economists. 2 years ago, I wrote a chapter for the Handbook of Commercial Policy together with Nina Pauchnik, where we took issue with what we consider to be the prevalent view at the time, namely that trade was so liberalized that trade policy had become completely irrelevant. And unfortunately, I don't think I need to try very hard to convince you today that this is not the case. 10 minutes is a very short time to comment on the consequences of trade. So I will focus, given that Rob talked about the aggregate gains from trade, I will focus my comments on the distributional consequences of trade and the work that has been done on this issue. And as a starter, I would like to make a point that seems obvious and in fact trivial, but we sometimes forget it, namely that trade does bring aggregate welfare gains to an economy, but it also causes disruption, it causes redistribution, and it's because of these disruptive effects that we often see opposition to trade. It's not that people don't understand that free trade can have benefits, it's because they don't want to be the losers. And what this means is that, in my view, that we actually need to study these distributional consequences and the policies that are appropriate for addressing these potentially adverse distributional effects. And perhaps most importantly, also address transitional dynamics. Having said that, there has been some work on these issues, and this work started in the 90s. And at the time, the main focus was on the increase in the skill premium that had been observed both in developed and developing countries. So there were some papers written on this topic by several people, both labor economists and trade economists. So Gordon contributed to this literature, I did, Nina Pauchnik did, and Harrison and several others, and Helpman and so on. And I think it's fair to say that the consensus that emerged from this literature is that trade had only, if at all, a secondary effect on the income distribution and on the increase in the skill premium. So we're all finding effects that were statistically significant, but in terms of economic magnitudes, the effects were too small for anyone to argue that trade was the primary driver behind the increase in inequality. So that was in the 90s. And then I think it's fair to say that in the last 5 to 10 years, the picture changed. So all of a sudden, academic studies started finding significant effects. And when I say significant, I don't mean just in the statistical sense, but also in the economic sense. And that applies both to studies that were focusing on the US. For example, the author, Dorn and Hanson paper. It also applies to many studies on developing countries. So the studies that come to mind are the studies by Topalova and various co-authors on India, Kovac on Brazil, Di Carneiro and Kovac on Brazil, Pauchnik and McCaig on Vietnam. So all these studies started finding very large effects on the income distribution. So one question that one may ask is what changed? So why did we all start finding effects all of a sudden? And I think there are two answers that come to mind. The first one is that it has to do with China, that the reason we find effects now is that China, in the meantime, has entered the world trading system, and by virtue of its size, China has had major effects. I think this view is partially true, but it's only a partial truth. And the reason is it may apply to the US. It certainly explains to a certain extent what author Dorn and Hanson have documented or Pierce and Schott, but it does not quite explain what people have observed in developing countries. For example, it doesn't explain the results for Vietnam. It doesn't explain the results for Brazil or for India, for all these liberalizations that occurred in the late 80s and early 90s, so much before China became an export superpower. The other explanation that I think is quite interesting, both from an intellectual and a practical point of view, is that all these studies tend to employ a different approach, and they tend to focus on a different dimension of inequality, namely regional inequality. So differences across regions with the differential exposure to trade. And these studies systematically find that those regions that were exposed more to trade had a very different experience from regions that were exposed less. So that raises in turn the question if there is something inherent in this regional approach that leads people to find large effects. And again, I can come up with two potential answers here. The first one is that these studies may not be quite identified. This is what the critics would say. So the usual argument is that there may be something else driving these developments, and it's not really trade or trade liberalization that's behind them. For example, there could be pre-existing trends that were intensified by trade liberalization, or there could be something else. I have to say, while I was editor at the AER, I received numerous comments that were making this point. I think in the end, my view is that the results of this paper survived. So maybe they're a little weaker if one takes this criticism into account. But I think it's fair to say that the results stand, that the evidence was not overturned by this criticism. So it seems, even though there are some identification concerns, we don't have randomized control trials here, there are identification concerns, but in the end, it seems the results are there. So what's the other explanation? The other explanation is that what these studies actually capture is general equilibrium effects. And when I say general equilibrium, I mean within the regions that they're applied to. So it's still the case that all these studies document only relative effects. So when I say relative, I mean they document effects that apply to some regions relative to others within a country. They don't document absolute effects, absolute welfare effects for the country. But one could argue that if we're interested in inequality, inequality is a relative concept by definition. So this relative focus is well justified here. And these studies, as I said, do document very large effects. So with that in mind, I think the focus on general equilibrium is actually what may be driving these very large effects that people find. So for example, when the dependent variable is poverty or even wages for the region or unemployment, they don't take into account only the effects on the tradable sector, but also the effects on the non-tradable sector. And it turns out if you take these effects, the general equilibrium effects, the aggregate effects could be quite large. That said, one caveat is important here. Even though there are effects on regional inequality, it is not the case that trade increases inequality. So in many cases, actually, even though many studies find that the areas that were exposed more to trade did actually worse in relative terms, in the sense that unemployment increased or wages went down, again, in relative terms, even though that's the case, in many cases, these were the regions that were better off to start with. For example, this is the case in Brazil, and this is the case in India. The areas that were exposed to more liberalization were the areas that were better off. So in fact, these relative effects that trade had at the regional level went in the direction of reducing regional inequality. That said, this is not a comforting message, because inequality was reduced in a way that we don't particularly like. It is not the case that those regions that were worse off came up. It's the opposite, that those regions that were doing relatively well did relatively worse after trade liberalization. I should also say that the effects tend to be very mixed across regions. So in Vietnam, for example, people find that trade benefited the areas that were exposed more to trade liberalization. The opposite is true in Brazil and Vietnam. So my time is up. So let me conclude with two observations. The first is that When it comes to distributional consequences, and this should perhaps not come as no surprise, the effects tend to be very context-specific. They depend on the country that implemented the reforms. It depends on the nature of the particular liberalization and on the initial conditions. So it's very hard to draw general conclusions as to whether trade increases or decreases inequality, but it seems that the evidence does suggest that trade has large effects on regional inequality. The second observation is that often what we observed in the data, what the studies documented, is very hard to explain within traditional models. And this is very exciting from a research point of view because it opens new areas for research. So I very much hope that in the future there will be more research in this area so that we have a better understanding of these mechanisms. So I'll stop here.
What I'd like to talk about are what we've learned about the disruptive effects of trade, and also what we've learned about learning about the effects of trade. Because there's been, I think, through the course of this literature, this very interesting interaction between reduced form work and structural modeling that has become symbiotic in a way that they were camps quite separate from each other maybe 10 years ago, and much less so now. So we think back, a dozen years ago or a little bit more, the view that we had that Penny just summarized of not thinking trade as having been all that important. The effects were certainly there. Work that a number of us did in the 1990s, the work that Rob and I did included, were finding impacts. It just looked like the impacts of technological change were more important. Part of the challenge we faced in that research is we were burdened by perspectives of the past. And one of those perspectives was the Heck-Scholin model, which told us that the construct we wanted to be working with was national labor markets that are segmented by skill. And so when we looked within those contexts, we weren't finding a lot. And in that context, you're not going to expect to see you're not going to expect to see impacts happening at a regional level or at an industry level. It's going to be happening by skill group. Mobility is going to erase those other margins of adjustment. So the China shock gave us an opportunity to invest this. So just always have to show this picture just to remind you how big it was. Following Deng Xiaoping's reforms, China's share of world manufacturing exports went from 2% in 1990 to 15% in 2010. And from the point of view of empirical research, this was both a blessing and a curse. It was a blessing because of the extraordinary opportunity this provided to observe what happens when a very big economy that is highly specialized in a particular set of industries opens itself very quickly. The curse is that this will never happen again. And so the external validity of this exercise has lots of question marks around it. And I'll come back to that at the end. So what did we learn as we dived into this? The first China shock paper was by Bernard Jensen and Schott, looking, and they started looking where you would naturally expect to begin, which is what happens at the plant level and what happens at the industry level. And we observed, not surprisingly, plants that were more exposed to import competition from low-wage countries in the United States being more likely to shut. The subsequent literature that added onto this, then all in a reduced form approach, began to document other margins of adjustment. And as Penny said, all of this work is looking at differences in outcomes between more versus less exposed groups. So you're capturing relative impacts. The GE effects are loaded either into time dummies, other controls, or somewhere in the error term that you hope aren't confounding the estimation. But as a first pass, you don't know anything other than the fact that if you're doing it right, that you're getting these relative effects. What we did learn was that we were able to validate these effects both by looking at more versus less exposed industries, more versus less exposed regions, and more versus less exposed workers. And so what this taught us is that there are a set of margins of adjustment that are operative that we hadn't really been looking at before. When we saw declines in manufacturing employment in a region, what happened was not those workers relocating to other regions, but we saw excess exits from the labor force, increases in long-run unemployment. And so this took a margin of adjustment off the table, this interregional adjustment mechanism, which we had just kind of assumed, and trade economists had been pretty sanguine about in the past. You can find lots of evidence if you look back in the labor literature that this was not a great assumption to start with. Go back to the work by John Bound and Harry Holzer in 1990, looking at the what happens to local labor supply of less educated men when you get adverse labor demand shocks. And what you saw was no regional labor mobility or very weak labor mobility in response. So it just kind of took the rest of us a couple of decades to catch up to some of those insights. And I don't want to take away from the lots of interesting stuff we've learned from the Monty Redding and Rossi Hansberg work on migration that happens inside some of these larger markets. So just to put some numbers on the table to understand this differential impacts and exposure. This is taken from my paper with Otter Dorn and Jay Song. From using Social Security Administration data, we're going to follow workers over time from 1991 to 2007, compare workers who in 1991 are identical in every observable respect. They earn the same wages, they've seen the same wage growth, they have the same tenure with their employers are the same size, pay the same average wages. One happens to work in an industry that gets hit by the China shock and one doesn't. So what happens? Well, if we look at low wage workers, what we see is that over the next 16 years, that more exposed low-wage worker, and here looking at the worker at the 75th percentile of exposure relative to the 25th percentile of exposure, sees about 18% less earnings when normalized by the initial earnings. Now, where does, if I look at a high-wage worker, what do I see? No differential effect in lifetime earnings between the more and less exposed worker. So now we've learned a second thing about the margin of adjustment in that stickiness is not uniform throughout the wage distribution, it's concentrated on low-income workers. So Hector-Aline was telling us to look at low-wage workers because we thought shocks were being transmitted across skill groups, but that's not the issue. The issue is that immobility is specific to skill groups. And one of the things we also learned about where that stickiness comes from is it's the ability to take up jobs outside of manufacturing. Those high-wage workers are making up for all the lost earnings they lose at their declining firm by moving outside of manufacturing. The low-wage workers in manufacturing are not. And so that's kind of a key clue for pushing this forward. Now, why are these impacts so big? So here again, we can turn to the labor literature for insights. And this is building on the landmark work of Jacobson, Lalonde, and Sullivan, using mass layoffs as an experiment to understand the scarring effects of job loss. And here I'm showing work by Davis and von Wachter that updates that work, in which they look at the consequences in the near term and the long term from job loss. And what matters crucially is, are you losing your job in the middle of a recession? If you are, then those short-run and long-run impacts are much more severe. Now, what's happening to these workers who are losing their job as a result of the China shock? They're losing their job in the middle of a local recession because many of these are small labor markets. And so the plant closures amount to a negative aggregate demand shock. Second thing we've learned is that the policy adjustment mechanisms were quite imperfect. We thought we had things like trade adjustment assistance in a place, unemployment insurance, and kind of some other means-tested entitlement programs. Turns out that much more than any of those programs was Social Security disability insurance, as in terms of responsiveness to workers hit by the China shock. So this is something that was really missing from our research and trade, is understanding how existing policy distortions can exacerbate these impacts. And I'll come back to this in just a second in terms of where research is going. So that first wave of research was reduced form, helping us understand these relative impacts. And then what happened after that is a bunch of very good general equilibrium analyses that have come along and built structural models to help us get a sense of what's going on. So Shea and Osa were kind of first to the table with this. And then we have the very nice papers by Caliendo, Dvorkin, and Paro, and Gale, Rodriguez, Clare, and Yi, which help us understand in the context of trade having disruptive effects, what do the aggregate gains look like over time? Those aggregate gains are still positive. They're just more unevenly distributed than we appreciated. Now, what's missing in those analyses? Well, what's missing is when you get a negative shock of this magnitude, it begins to unravel the social fabric. When you remove high-wage jobs for less educated males, what happens? Marriage rates falls, single parenthood rises, the fraction of kids living in poverty rises, and the incidence of males engaging in risky behavior, drug and alcohol abuse increases, and you get increases in mortality. Well, that unraveling of the social fabric can have very persistent effects, even if some of these labor market effects begin to wash out. So that's one thing that's missing in the research. The other thing that's missing is understanding the way in which the existing policy environment, especially when it comes to social policy, shades what that looks like over the longer term. So finally, I want to close just two very brief comments on what we've learned about methodology. First, trade economists have been using Bartik for 25 years, but it took trade economists to come along and start using Bartik till we figure out how to use it responsibly. So what we've learned is that friends don't let friends use Bartik unless you validate orthogonality conditions and cluster your standard errors appropriately. Now, how exactly we cluster, we're still figuring out, but it's a very interesting conversation. But finally, what we've also learned is the way in which reduced form work and structural work can interact, in which this can be part of an iterative process. That reduced form stage of analysis tells us what the relative impacts are. It doesn't tell us about the GE effects because that's lost into the other stuff. The GE models are can then build themselves around understanding which adjustment mechanisms are operative. And then once you have those models in place, you can go back and figure out what did those relative impacts actually mean. And it turns out the relative impacts were pretty close to the absolute impacts. And that's now led us to where we are now, which is an updated prior of what these local economies look like. And they look a lot like small open economies with limited labor mobility. And that's a really useful insight as we move forward to try and understand the longer term ramifications of these very big shocks.
My main message is that we are entering into a target-rich environment for the study of applied trade policy. That is, for the past couple decades, we sort of shied away from looking at actual trade policies to looking at quantitative models of hypothetical trade policies. And there's the promise of a new era in which our counterfactual policy experiments will become factual policy experiments. And we can take advantage of this, and this is a great opportunity for all of us. Now, I come at things through the lens of economic history. And one of the reasons I focused on economic history is I've looked for big trade policy shocks in the past to try to identify things and see what happens. If we look at just trade to GDP ratios from the past and try to think about where are the big changes that we've seen. If we look at the late 19th century into the early 20th century, trade to GDP ratios are very stable. We see this globalization era after 1970 where trade to GDP ratios rise. And of course, a lot of work has gone into understanding that. But it's really thanks to NBER researchers such as Doug North, Robert Gallman, Robert Lipsey that we can push this diagram further into the past. And what we see is that trade has been played a very large role and a very volatile role very early on in American history. And a lot of this volatility was trade policy induced. And perhaps the greatest trade policy experiment, I think, in US history is the Jeffersonian embargo of 1808, where President Jefferson declared an end to overseas shipping for a little over a year. Now, what possible relevance would an embargo aimed at a major trading partner that's also a potential geopolitical rival conducted 210 years ago at a time when the trade share was about 15% of GDP, what possible relevance would that have to today? After all, don't we live in the world of WTO rules and low tariffs in general? Well, I'm sure you're all aware of this President Trump tweet where he talked about how trade wars are good and easy to win. But what went overlooked in a lot of the coverage of this tweet is later on he says, if a certain country gets cute with us, don't trade anymore. We can win big, it's easy. This sounds not so much like an embargo, but the Trump administration has floated the ideas of imposing tariffs greater than the value of US imports on China, which might come close to an embargo. So maybe it's not so far-fetched, this idea. Now, we can't make policy recommendations, of course, at an NBER event, but I will say there's one study of the Jeffersonian embargo which says that it shaved about 5% of US GDP off within 6 months. and I'll let you decide whether it was a good policy or not. And of course, we can't make that determination until we know what was the objective of that policy. But at any rate, since we are here in Boston, the embargo had a big impact, of course, on the local economy here in Cambridge and Boston. It was very hard hit. It was a major seaport, a major commercial hub for the New England region. And of course, the way you would protest trade policy back then is you'd have to write the president a letter. And so there is one such letter from someone in Boston written to Mr. Jefferson only a month after the embargo was imposed. And the first line of this letter says, "You, Mr. Jefferson, you are a friend to the disturber of the peace and the greatest enemy of the whole world." And the letter goes downhill from there. So if you think that we're in a poisonous political environment today, please take a look at American history and you might get a different perspective on how we've evolved over time. But let's look at trade policy measures. So one reason why trade policy, as Penny pointed out, hasn't been thought to be all that important in recent years is we've had this period of about 60 years where tariffs are pretty low, pretty flat. There's not too much action there. But of course, once you push things back, you see there's been a lot of action in terms of tariff movement. And this gives us lots of opportunities for identification, interesting policy experiments, and what have you. And so there's a lot to be mined there in terms of the past. Now, you might notice that there's a big tariff reduction there between, say, 1932 and 1952. And interestingly, that's not all due to policy. In fact, relatively a small amount of it was due to policy. A lot of it was due to the fact that we had specific duties in place, we had higher inflation, and that eroded the value of those duties. So it was a policy decision not to do anything about this erosion, but it wasn't a deliberate policy to actually take the tariff from 60% down to 10% within the span of less than 2 decades. So tariffs historically have been pretty high and oftentimes volatile. The past 60 years they've been fairly low and stable. But now, about a year ago, President Trump said, apparently in the Oval Office, bring me some tariffs, I want some tariffs. And finding the appropriate legal provisions to allow the president unilaterally to raise tariffs, mainly Section 301 of the Trade Act of 1974 and Section 232 of the Trade Expansion Act of 1962, his advisors delivered. And now we have some tariffs in place. This is a chart from The Economist that shows basically what Rob was talking about, some of the tariffs that have been imposed recently. It's only 2 weeks old, but it's already obsolete. And we have to move this line down from threatened to actually imposed in terms of some of the extra steel tariffs and the China tariffs. The numbers here are fairly large. The big one, of course, is at the very bottom there, which is automobiles. And I would remind you that Penny and Rob sort of started their careers by looking at trade policy regarding the automobile industry. I think maybe it's time to dust off some of those things, not impose VERs, but potentially a 25% tariff if the Trump administration is moving forward with tariffs on automobiles. Of course, one big difference from trade policy in the past as opposed to trade policy today is that, yes, tariffs are back, but now we have the rise of intermediate goods, global value chains, and things of that sort. That changes the calculation, of course, in terms of the economic impacts, particularly when we're talking about the steel tariffs and the aluminum tariffs and perhaps some of the ones to come. So Secretary of Commerce Wilbur Ross famously showed a can of chicken noodle soup from Campbell's, which now I feel obligated to bring with me wherever I go so I can explain the possible downstream impacts of steel and aluminum tariffs. And yes, he's probably right. The price will only go up by a cent or two. Who could possibly feel that? Maybe it's not such a big impact. But if you are producing, say, the Dodge Ram truck, the F-1500, there's a lot of steel and aluminum in that. In fact, there's another product that has even more steel and aluminum than even a Dodge Ram pickup truck, and that is, of course, the beer keg. There are only 1 to 2 domestic beer keg producers in the United States, and they're teetering now on the brink of bankruptcy because their input costs have risen. So my question, which is a political economy question, is where are the consumers? That is, why aren't our college campuses in uproar over the fact that these beer keg prices could be going up? Now, this is a particularly sensitive issue on my campus at Dartmouth because a beer accounts for a large part of the caloric intake, I think, of the average undergraduate in a given week. And in fact, the unofficial mascot of the Dartmouth undergraduate is called Keggy. Well, I'd like to say that the reason why the consumers are not more upset is because the Dartmouth Economics Department and Business School, which are filled with many fine trade economists, have met personally with all the fraternities and sororities and assured them that Chinese retaliation against U.S. agricultural exports has actually reduced the price of those goods domestically, particularly in terms of hops and barley. And therefore, the impact on the price of beer is mitigated because even though the price of kegs is going up, the input price on the agricultural farm products that go in has gone down. That's not the story, however. Dartmouth banned kegs a number of years ago. But it does raise the issue of political economy. So now I want to get to some of the research implications for what's different in the environment today as opposed to the past. Well, the one that I think is very clear and stands out that's different today from the past is the rise of global value change and the downstream user effects. It's very interesting when you look at the trade policy in the 1980s in the Reagan administration. It was very hard, I believe, to get downstream user industries to vocally oppose a lot of the measures that were being imposed. Now it's very common to see downstream industries make their voices heard. And I'd point to work done at Dartmouth by Emily Blanchard, Rob Johnson, and Chad Bown in terms of the implications for trade policy of these global value chains. The second issue, of course, is trade policy uncertainty, and that certainly describes the environment we're in. This has been an area that Kyle Handley has taken a lead role in with Nuno Lamau, but also Deborah Svensson, Meredith Crowley, and others have done some work on identifying the trade policy impacts of, the impacts of uncertainty on investment decisions, trade decisions, and things of that sort. I think that will continue to be a fruitful line of research. Third, when does retaliation work? So this has not been the subject of so much research because we've had the dispute settlement system, a very orderly process to adjudicate trade disputes. But now we're in a world where retaliation may happen quite quickly, bypassing even the WTO. So that makes us want to investigate the question, when does retaliation work or achieve its objective, or when does it not? Lastly, I think there are a bunch of political economy questions that are very interesting here. Now, of course, our workhorse model for political economy is the Grossman-Heltman model, which is premised on the idea that trade policy is driven by people in the government who are, first of all, industry demands for trade protection, and politicians who are driven by campaign contributions. Well, the challenge is here that we have a U.S. president who was elected outside the system, is not really dependent on campaign contributions, and who seems to be imposing import tariffs even when there's no industry demand, such as in the auto industry, where the auto industry actually doesn't want many changes because they're already globally integrated. So what does this say about our political economy models? Related to that is trying to assess the politics of import, the response of domestic firms to import competition in terms of political demands. So Gordon's done, of course, some pioneering work on the China shock. Here's some 3 recent import shocks to the U.S. So it's looking at imports as a share of GDP from 3 particular countries. The first one, the blue one, is Japan. Now, of course, you can see that surge in imports coming from Japan in the early 1980s, and we know absolutely what happened there in terms of the trade policy response. Many demands for voluntary export restraints, anti-dumping duties, and the like, huge demands for trade protection. The second line there is the yellow one from Mexico. That's an endogenous response to NAFTA, of course, the fact that imports are going up. There hasn't been many demands to stop those imports coming in from Mexico. Now, the China shock is obviously one of the largest ones there. It's particularly enormous in terms of its impact on imports as a share of GDP. But what's ironic here is despite the fact that Gordon and his colleagues have been able to identify big labor market effects, there wasn't so much of a political economy reaction against those imports as one might expect. So just to take one measure, anti-dumping petitions filed. A big run-up in anti-dumping petitions filed in the early 1980s, strong dollar, growing trade deficit, a lot of imports from Japan. Anti-dumping petitions sort of have dropped right off from the early 1980s, mid-1980s. And so right as the China shock is sort of most intense from, say, 2000 to 2010, there's an almost a major drop in the number of petitions filed by import competing firms complaining about foreign competition. So I think this is interesting too. Is it the rise of foreign investment in China? Is it global value chains or what have you? The last point I would make is that I think there's opportunities for symbiotic research between members of the programs ITI and IFM, which have been segregated, I think, for some time, even though when international studies started the Bureau, it was under the leadership of Bill Branson, and it was macro and the trade economists all together. And the reason for this is that a lot of the issues, trade policy issues, of course, are bound up with the macroeconomic phenomena and as well as the trade imbalances. For example, there's a piece of legislation that's been circulating apparently within the White House, and it's premised on the idea that trade imbalances are being driven by trade barriers. Now, this is, I think, a questionable premise to say the least, but it's one that's gaining some currency, I think, in policy discussions. And I think it's something that IFM and ITI could join forces and try to look more into. I should note that the title of this legislation is the U.S. Fair and Reciprocal Tariff Act, which goes by the unfortunate acronym of FART. And of course, it's given rise to many jokes that I won't get into, such as, will Congress pass FART, and things of that sort. But I think there's some serious issues that that deserve examination. Last point, of course, is if you're interested in more of the history of some of these things in comparison over time, if you are a NBER program member, you can get a free copy of this book, Clashing Over Commerce, by contacting Helena Fitzgerald. Thank you.